Good morning from our global headquarters in New York. I'm Menace Crenny. You're welcome to Bloomberg Brief. Let's set your agenda. The last bear standing, JP Morgan's Marko Kolanovic doubles down on his gloomy outlook for stocks just a day after Morgan Stanley's Mike Wilson capitulates. FDIC Chair Martin Gruenberg says he'll step down after allegations of a toxic work environment at the agency during his tenure. And two major retail earnings hit the tape today. Macy's and Lowe's give us an estimate of the health of the US consumer. A very good morning. It is Bloomberg Brief. This is the state of play. In the game of poker, stocks are flat at the moment, but in the game of poker of calls, you've got the Premier Kolanovic holding on to his 4,200 level. No reason to buy. At least Wilson capitulated yesterday and said, look, this market could move by 2% higher between now and June 2025. Max Kettner at HSBC, we know, is an evangelist of everything rallies in the markets. Keep an eye on Palo Alto at the bottom of your screen. The security software company, guided lightly on fourth quarter, and the stock is being blasted lower this morning by 8.3%. To the bond market, 442 is where we are. We've had 3 weeks of gains. Yes, the reprieve. The chime from the Fed, Mester and Bostic, is a steady state is where we want. By the way, keep an eye on gilts. BlackRock have gone overweight developed market bonds for the first time in 5 years. They're cautious on the US. You want to be long tips, but their top pick is the UK at the bottom of the screen there. We've got a nice slate of bond issuance, 25 to 30 billion of investment grade. Will the market lap it up easily? And crude is down by 0.8%. It's a sloppy physical market, says Halima Croft at RBC. I'll ask Nadia Martin Wiggen what a sloppy physical market actually means. So I've referred to the perma bear. There is one left on Wall Street. It is JP Morgan's Marko Kolanovic writing this. We do not see equities as attractive investments at the moment, and we don't see any reason to change our stance. This after Morgan Stanley's Mike Wilson threw in the towel, boosting his S&P target to 5,400. My guest this morning is Seema Shah, Chief Global Strategist, I should say, for Principal Asset Management. So, Seema, good to have you with me. Kolanovic is holding on like the Grinch with that position. Wilson capitulated. He sees a sunny macro environment, but that sunny macro environment's only worth 2% on the upside. So is that a conservative call, or is that at the money for you? Good morning.
Good morning. It is. So I wouldn't say it's very, very conservative. I think from our perspective, we are expecting further gains, but nothing as tremendous as what you saw certainly in Q1 of this year. But we're not in Kolanovic's camp either. I mean, to be a bear from here, you have to be really assuming that there's going to be a fairly significant slowdown in the economy and maybe further disappointment from a rate perspective. So there's vulnerabilities, but if we're looking out over the growth story, it's still fairly solid. And if you're going to have solid growth, you're going to have solid earnings, and that should be enough to propel the market a little bit further.
And I hear that those are the pillars, I think, of most market participants. But then it comes down to, I suppose, differentiating where exceptionalism is. Peter Cheer over at Academy, I like what he said. I like my exceptionalism to be exceptional. And so, therefore, I want to get a sense from you, does US exceptionalism prevail? Or is it going to be as formidable as it was, or do you downgrade it ever so slightly? Look at what BlackRock are saying. They want to be long tips here, but they want to be longer of the UK in the rates market. So exceptionalism, does it hold for the US relative to ROW?
So look, it depends. What is your time horizon? I mean, if you're looking out over a longer term perspective, yes, US exceptionalism still stands. But I do think that at the moment there are potentially some more attractive opportunities outside of the US, mainly across developed markets. If you just think about even Europe, where if you do a comparison to the US, where we have expensive valuations, we're not entirely sure what the Fed rate path is going to be. And if anything, you're getting economic growth downshifting. But then you look over to Europe, where you know what the rate path is going to be. We're fairly certain that the ECB is going to be starting cutting rates very soon. Valuations more attractive. And you're also getting upside economic surprises. So certainly that leans into the international market rather than the US. I'm not sure that will be sustained for too long, but at least you've got a window of opportunity right now.
But yet you do see a broadening of the market rally. We're counting down to NVIDIA. I mean, there was a phenomenal piece of theatre yesterday, I thought, between Jensen Huang, along with a number of other CEOs, the Dell CEO. The options market is betting, Seema, for an 8% plus or minus. I know those are slightly out of the money options, and we can write a great story about get ready for an 8% rally or rout of 8%. But it is pivotal or how pivotal is it to sentiment and then allocation, Seema?
Look, it is inevitably, it is important because it's such a large part of the market and there's so much riding on this idea about AI and tech. But I think if you're, as an investor, you don't want to be looking at the immediate term. You want to be looking out over the next 3 to 6 months. And as investors in tech, we're looking at it from a kind of a couple of year horizon. So there could be some disappointment, certainly with specific stocks in the near term. That's always possible. But when you look at over a 3 to 5 year term, we do think that tech is going to continue to deliver. So we are maintaining our overweights to that mega cap, large tech perspective. But we're also starting to see that there are other opportunities in the market where you do see a broadening of the rally that you've seen, probably to parts of the market which have been somewhat unloved up till now and where valuations are a bit more attractive.
I'm always curious to get professionals' view on how all in on this market we are. And Max Kettner is pretty bullish, I've got to say. I mean, he's almost an evangelist in terms of his model. Everything rallies for Max, so we'll get him on soon. But he talks about the market, real money being, and I was surprised at this, slightly overweight equities. How would you describe positioning? If Kalanovic, is holding on to his perma-bear situation, Wilson capitulates and goes for 2% upside from here. Goldman says we're pretty fully valued. How do you think real money is positioned? Is it lightly into these equities?
I think the real money is looking at the market and they're saying, look, we like the outlook. We have got some concerns about valuations and they're looking for some opportunities. I was in the US over the last 2 weeks and the conversations that you have, there are still some fears that maybe the market has gone too far, so there's vulnerability. But they're looking for the opportunity to get back into the market. It's just that the timing, I think, is what people are struggling with. So I think there's still opportunity ahead, but certainly maybe there needs to be another catalyst to come.
So if you've gone out to see the clients in the United States, I'm dying to know, how concerned are they about politics? I mean, we're counting down. We're 24 weeks away. What are they perhaps most concerned about? Did politics feature high or low in that conversation agenda?
It's interesting. It actually wasn't as high as anticipating it to be. I think when people are thinking specifically about the US election in the US, they're not so worried about what happens to the US market. They're a little bit more concerned what happens to the international markets, particularly, of course, China, and to Europe. It's one of the reasons why I think there is still that caution with, when it comes to thinking about the UK and Europe. But certainly nothing to what we would have anticipated before, with almost a lack of concern. I think everyone knows what's going to come in from a US election perspective. I think the biggest takeaway that I had actually from the US was actually they had they don't mind, or they're not too concerned about what the Fed is going to do next, about the timing of the rate cuts. They're looking at the market and saying, look, we know that the growth profile is pretty strong. The Fed may deliver it September, December, January, who knows? But at least in terms of a fundamental basis for the market, that can continue to keep it going.
And just reflecting back on BlackRock, I think it's interesting. They've gone overweight DM bond markets for the first time in 5 years. So this is quite a significant shift in gear. Now, the lean is they think the UK is where their number one choice is, because the presumption is that, I suppose, those markets, this is what they say, we're now overweight developed market government bonds overall on a strategic horizon for the first time in 5 years, and they lean into the UK. Does that chime for you in terms of duration, US relative, let's say, to gilt, to Bund, or to other bond markets?
I think it does to some extent, because certainly if we're looking at the central bank profile, we look at the Fed, and I know, of course, there's going to be debate about the exact timing, but we are expecting a shallow cutting cycle. We don't expect there to be many cuts over the next 18 to 24 months. Whereas if you look across to Europe and the UK, for the ECB and the Bank of England, we know that there's going to be rate cuts fairly soon, and their profile is going to be a little bit more aggressive. So there's a little bit more urgency to ease monetary policy over the next 2 years. So yes, I kind of agree with BlackRock in that your opportunity set is probably better in terms of international bonds over US.
So I don't need to switch the old sterling into dollars yet and go long Treasury. Seema, thank you very much. Seema Shah there, our guest this morning, setting the agenda on markets at Principal Asset Management. Other stories trending on your Bloomberg terminal this morning. President Biden has forcefully defended Israel against war crimes, the charges sought by the International Criminal Court. And the ICC chief prosecutor says he's seeking the arrest warrants for Israeli Prime Minister Benjamin Netanyahu and the Hamas leader Yahya Sinwar. The US president called on the court's decision to target Israel's leaders outrageous.
We reject the ICC's application for arrest warrants against Israeli leaders. Whatever these warrants may imply, there is no equivalence between Israel and Hamas.
There are signs of upward momentum for the US approval of ETFs investing directly into the second largest token, Ether. The SEC has contacted at least one exchange and at least one potential issuer to update the related paperwork. Now, this move would be unexpected in terms of giving a green light is by no means guaranteed. And Peloton has kicked off the sale of a new loan as it works to refinance existing debt and recover from a recent slump in sales. Fitness company is said to have launched a $1 billion leveraged loan offering yesterday. The proceeds will refinance existing debt. Coming up on the show, are you ready for retail? Macy's and Lowe's results hit the tape before the bell. From a takeover bid to the consumer pullback. More on those stories this hour. Hey, it's Bloomberg Brief. I'm Menace Crenny in New York. Now, Bloomberg scoop, ASML and TSMC, as we understand it, have ways to disable the most sophisticated chip-making machines should China invade Taiwan. What are the details? Tom McKenzie is with me. So, Tom, this is a great scoop by the team. What exactly are they capable of doing, and why are they making this announcement now?
Yeah, well, they haven't made the announcement. It is down to that fantastic reporting, as you say, by the team in the Netherlands, backed up by the team in the US. But what we have learned, what they have learned through their reporting, is that ASML and TSMC, who have this symbiotic relationship, have assured officials in the US primarily that they have this ability to shut down these machines, the kill switch. Remotely, they can close these down. What are the machines we're talking about? We're talking about these extreme ultraviolet lithography machines, the machines without which you cannot produce the most sophisticated chips. ASML makes them, they ship them to TSMC and their foundries in Taiwan, and the two companies, again, work in partnership to ensure that we have the most cutting-edge chips for our mobile phones, but also, of course, importantly, for our military systems as well. And that's where the concern of the US lies. They've been pressuring the Dutch government, they've been pressuring ASML and the Taiwanese to assure them that if China was to invade Taiwan, they would have the ability to ensure that those machines don't get into Chinese hands. And this has been the response from ASML and TSMC. We have this kill switch, they say.
Yeah, I mean, my apologies there. This is a Bloomberg scoop rather than an announcement by SML. It's sort of, if it is actual fact, it's sort of that scorched earth, the ability to deliver scorched earth from a protection point of view. Then that brings the bigger question, Tom, I think, and this is the point that you make very clearly, is about the political calculus vis-a-vis Washington and Europe's policy towards Beijing, because, of course, there has been this impact on ASML in terms of what they can export to China, and that is going to hit their numbers this year. But do you think from a political dynamic, if this comes into being, the ability to deliver scorched earth, will it shift the calculus?
I mean, you're absolutely right, Manus, on that front, absolutely. And in terms of the impact on ASML and then in terms of the politics, one, the impact on ASML, they still get 25% approximately of their revenue and sales from the mainland Chinese market, the other 25% approximately coming from Taiwan. So this is a major market still for ASML. And yes, to the politics, you're also absolutely right in terms of how you frame this. It underscores the urgency of officials in the US who are concerned that China is making rapid leaps and bounds in terms of the catch-up on the ability to produce these chips, and that they're able to do that with some of this kit and technology provided by the Netherlands, by Japan, and they've tried to close that loop. They tried last year, so the ASML is restricted from sending its most sophisticated machines to the Taiwanese, to the Chinese market, I should say, and now there's this additional measure. They wanted this reassurance, and some within the military complex of the US suggest that China could be ready to invade Taiwan by as soon as 2027.
OK. Well, it's sort of jangling the nerves globally on the political stage. Tom, thank you very much. Tom McKenzie with the very latest on ASML and TSMC. So after facing weeks of criticism, the FDIC chair, Martin Gruenberg, will step down once a replacement has been found. Now, this is after reports of a toxic work environment put the regulator at the centre of a heated political fight and fueled the calls for his removal. Joining me now is our managing editor for EMEA Finance, Tom Metcalf. Tom, Gruenberg had promised to clean up the FDIC. And I suppose the question is, and this is a very political issue, is how soon can Biden replace him? And how hard is it going to be to find that successor?
Yeah, well, in terms of the time frame, they'll be wanting to move very quickly on this. They'll obviously want to keep kind of a Democratic appointee at the top of this organisation. And it's helpful that the department chair is sticking around. It kind of gives them that flexibility to really move this process forward. In terms of likely candidates, there'll be, the usual spaces. They might be looking inside the FDIC, but I suspect, given the nature of this report, very damning about the culture there, they'll be looking further afield. And this idea of having a clean broom and hopefully find a way to get this organisation back on track.
It's certainly politically split, isn't it? 2 Democrats and 2 Republicans, and the vice chair takes over, was quite vocal in terms of some of the regulatory proposals and criticising those. In terms of another change of leadership, this time, of course, we're talking about JP Morgan. Jamie Dimon seems finally to be setting a little bit more of a guardrail up around the succession plan. He was sort of very clear yesterday that it might not necessarily be 5 years away. So who are the characters that will sort of ascend in our attention at JP Morgan now?
Yeah, for the first time, really, Jamie Dimon suggesting, he's always been given this pat answer of, I'll be 5 years away, and constantly gave that answer, whatever the time frame was. So, what this really puts a spotlight on is those, I would say, the 3 internal candidates who are kind of viewed as being the front runners right now. Obviously, these things can change. But, for example, you've got the head of retail there, Marianne Lake. You've also got the 2 co-CEOs of this gigantic unit, the Commercial and Investment Bank. And I think those 3 are really viewed as the most likely sort of successors. But of course, look, Jamie Dimon being Jamie Dimon, he has added a little bit of clarity, but there's plenty sort of wiggle room. And he also had a great line where, he said, yes, I may well step down as CEO, but I wonder if I stick around as chairman. So, that would be a very interesting situation. So it's, as ever with JP Morgan, a constant guessing game, a huge sort of issue, and clarity on this will be really appreciated by the stakeholders, but I don't think it's going to be clear for at least another year or 2.
Could you imagine living under the shadow of your chairman, of Jamie Dimon, if you've just been appointed to JP Morgan as the CEO? I'm sure it's not a shadow necessarily that you're going to break free from very easily. Tom, thank you very much. Tom Metcalf there, tracking the stories this morning on Wall Street. Coming up, a look at what else is making the headlines around the world. Context matters on Bloomberg. Good morning. Microsoft introduced new software and computers infused with AI features as it steps up its efforts to compete with Google and Apple. The CEO, Satya Nadella, spoke exclusively to Bloomberg about the AI race.
It's a really ground up, reimagination from silicon. So we have a new SoC that has the NPU. So think about it as we've always had CPUs and GPUs, and now you have neural processing units to, in fact, locally process these AI models. We have 40+ AI models that are local on Windows machines that then are being used by a variety of experiences that we have built into Windows, starting with this photographic memory feature called Recall, which is just phenomenal. And of course, Copilot is built in to Windows. And Copilot is just not an app. It's sort of a shell affordance that's going to be there assisting you as you be showed a demo of somebody playing Minecraft, and me just sharing my Minecraft screen with Copilot, and Copilot helps me finally be as competitive with my daughter on Minecraft as always dreamed of, right? And so And then, of course, the third parties. I mean, Adobe showed how they're bringing all of what they do to Copilot plus PCs and many, many more other developers. So it's an exciting day for us to have a complete rethink on the full stack of Windows for the AI age.
I bet you're pretty good on Minecraft, just a hunch. This new feature recall means your computer basically has a photographic memory of everything you do on it. And the speed at which this is all happening is just so fast. It seems so unprecedented. How will this really make things different for consumers and change our daily routines?
Yeah, I think if you think about the PC, it has always been about creating things, right? Which is, it's about being able to synthesize lots of information, create new information, pass better judgment, gain insights, and act, right? That's what you sort of do on a PC. AI is an assistant. AI helps you as an end user do anything, right? So one of the most beautiful demos today was even this thing called Co-Create, right? I am in Paint, and I'm painting a nice spring Seattle day, and I want mountains with wildflowers, and I can now have the AI assistant. That painter in me now can be inspired by AI, but ultimately I'm the one painting, and I get that satisfaction. Like, I feel one of the things that's been, one of my coworkers was telling me when her 5-year-old is saying for the first time, give me designer time. That's what felt, it feels like in the late 80s and the early 90s when we all fell in love with PCs. That was what really got us going, which is the ability to use computers to create. And I think this AI is just going to take it to the next level.
Pace of change there, Emily Chang and Satya Nadella. Let's get you up to speed with the front pages. This is the main story of the day: succession in Iran. From our global headquarters in New York, I'm Manus Krenny. Let's set your agenda. The last bear standing, JP Morgan's Marko Kolanovic, doubles down on his gloomy outlook for stocks just a day after Morgan Stanley's Mike Wilson capitulates. FDIC Chair Martin Gruenberg says he'll step down after allegations of a toxic work environment at the agency during his tenure. And two major retail earnings hit the tape: Macy's and Lowe's before the bell, defining the exuberance of the US consumer. A very good morning to you. Stocks are nervous. We're counting down to that all-important NVIDIA moment. So 53.30 is where we are. You've got Kolanovic, the perma bear, still holding on. He's got blood on his fingernails. He's still holding on to 4,200. That is 20% below here. No reason to buy. And just think 24 hours ago, Mike Wilson capitulated over at Morgan Stanley. So there is the battle of the game of calling this market. Real money is still slightly overweight equities, according to Max Kettner. NVIDIA is at the bottom of your screen now. You're going to see that we're counting down. The market is preparing for an 8% swing on NVIDIA. Had a nice day yesterday. Palo Alto under pressure. Fourth quarter guidance on their billing. This is the software security company. Really taking a smack this morning as their guidance was off. To the bond market, you've had 3 weeks of gains. And again, some caution from BlackRock. They're overweight developed markets for the first time in 5 years. They're cautious around the US. They want to be longer of inflation in the US. And we have a slate of bond issuance, $25 to $30 billion worth of bond issuance. Oil is down by 0.9%. We're going to be range bound, according to Halima Croft and the team over at RBC. And we have sloppy physical markets. I don't quite know what sloppy physical markets are, but it sounded good. So in terms of the narrative for these markets, again, from the Federal Reserve, we have the restrictive narrative from Loretta Mester, from Bostic. Bostic wants to stay in a steady state. When it comes to duration, we have heard from Seema Shah, from Principal Global Advisors, again this morning, talking about the sort of slight hesitancy on duration. JP Morgan say they remain neutral on duration. It's just too early to add to that. So I mentioned the Fed and the narrative from Loretta Mester and Raphael Bostic. And Bostic doubled down on his higher for longer mantra. Meanwhile, you have the Cleveland Fed President Loretta Mester saying that 3 rate cuts in 2024 are no longer appropriate.
I was on the record before saying I was at the median, which was 3, The developments I've seen in the economy right now, I would not think that that's still appropriate because the inflation risks have moved up. It's too soon to tell what path inflation's on, so we just need to collect more information on that. In the first part of the year, what we saw was the risks that we were too restrictive have gone down. You know, last year people were worried about, oh, the Fed may be getting too restrictive and therefore it's going to dampen the economy. Those risks went down. At the same time, the risks to inflation, I think, are tilted to the upside and remain so. And so that's the balancing that we have to do as we set policy going forward.
I do think that our new steady state is likely to be higher than what people have known over the last decade, maybe back to where we were in the 1990s and 2000s, but we'll just have to see. Anything can happen. My outlook is really that inflation will continue to fall through this year and into 2025. You know, I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Atlanta Fed President Raphael Bostic, along with Cleveland's Loretta Mester, speaking exclusively to Bloomberg with Mike McKeep. So that's the bond market tucked away. The gold market takes a breather this morning after hitting record highs. Nadia Martin Wiggen of Svelland Capital writes this. Unlike 2008, when oil became the new gold, which was a demand-led rally, in the current commodities upcycle and gold rally, supply and security concerns are the top priority. Nadia Martin Wiggen joins me now. Nadia, good to see you this morning. So this is about really a gorging of central banks who are politically worried about their exposure to the United States. Is that ultimately what's driving the real alpha in gold this past couple of months? Good morning.
Good morning. Absolutely. When we look at Q1 buying of physical gold, it was led by China, who bought $2.5 billion worth. It was led by Turkey, that bought $2.5 billion worth. We saw additional buying from India, Kazakhstan. And when we look at this growing influence of this gang of BRICS countries, we expect sharper buying from the likes of Saudi Arabia, UAE, and also Russia when they think about stabilizing their economy while the war rages on in Ukraine.
Is this a form of de-dollarization? I mean, we've heard some sort of saber rally. I mean, obviously, gold is priced in pejoratively in dollars, but is this a form of removing and protecting themselves politically, geopolitically, from the U.S. and from their treasury holdings?
And from sanctions against their holdings. As we see now, you know, even the Germans are on board with using the extra interest on the frozen assets taken from Russia to help pay for weapons in Ukraine. Mm-hmm. I think in addition, when you look at Chinese retail buying, part of that is also about thinking about maybe a devaluation, but the real drive in terms of the bulk of buying are these central banks, and the world is incredibly unsafe and unstable if we compare it to how it looked 25 years ago. So every government is looking at this.
So we're looking at a price of gold over the past year up 22%, $2,416 and change. Never forget the 57 cents. But we are running into, I would say, a buffer of where the consumer side, we are seeing a little bit of demand destruction. Is it fair to say that overseas purchases of gold fell by 30% month on month in China? So are we at some kind of a sense of exhaustion point in pricing, or will the central bank buying trump all the retail demand?
The central bank buying will absolutely trump the retail demand. And what we've seen also on the ETFs and on the paper market is there's been exiting on that side. But it's been the physical buying that has been the focus of the central banks. They want to hold it in their vaults.
So let's flick it over to the copper market. Jeff Curry, we know, has been a long evangelist of copper. Copper is the new oil. I mean, I could wax lyrical on behalf of Jeff, but I think we can move on from that. On a slightly more serious note, let's disaggregate this. I mean, we are just exploding on copper. So the first thing I want to understand is, to what extent is that just a blowout on specs relative to the demand structure? And I put that to you because we've seen this in the commodity market last year or 2 years ago when the Russian war on Ukraine began, and we saw this violent constriction and trading by hedge funds in electricity and in the commodity markets at that point. So explain to me what's happening in the copper market.
Yeah, so when we look at that medium-term picture, energy transition, population growth, movement of cities from the G7 with the largest populations and industrial demanding, electricity demanding to the emerging markets, that's the long-term copper story. What has really been a catalyst right now when we think about versus 2020, 2022, has been this realization that AI requires a ton of energy, and to build out that energy supply, we need copper. And most importantly, we need the grids. And so that has been the catalyst in the short term to make things pop. However, when we look at the shape of the curve, we're still in contango in the front, right? And it's really in December where we hit that backwardation. So that is where the market thinks in December we'll have that real supply spike. But when we look at what happened in the cocoa market, for example, that took 3 years to build up that trade. Now copper is having this side where we have this demand catalyst, but the main problem is the supply, because we don't have a shale solution. So when you say copper is the new oil, it is like oil was in 2007, 2008, because we didn't have shale back then, right? You needed this long-term supply to actually cover that demand. So when we look at prices now in copper, in order to get us to a point where the market can rebalance, we will have to hit a demand destruction number. So that is much, much higher than I think what the market is perceiving right now. So 15,000 could very easily be hit quickly, as we saw with algorithmic trading. When we see CTAs, what happened with NVIDIA. We could have that exact same thing happen in copper, and there's no stopping them once that momentum is going until we hit a demand destructive number.
So that is a lumpy call. $15,000. We're at 10,869 and change at the moment. So what proportion of that is just pure spec, and what proportion of that is betting on AI, the greenification, the military use, the AI? Is it those solid pillars of demand that can propel me to 15,000, or is it just short-term vol and financial manipulation?
When we look at the energy transition and that changeover, it is happening, right? We've seen China spend over $500 billion last year just on upgrading their grid system. They're going to do similarly this year. We have seen them be the #1 investor in renewable energy. That is something that is going to spread to other parts of the world, especially when natural gas isn't as easily available as cheaply. Of course, that is also going to be growing very quickly on the LNG side. But we also will have this renewable side driving it. When we look at the grid system in Europe, for example, 40% of the grid system is more than 40 years old. That requires a ton of copper. And another thing I would just add, last year, a lot of the market was already waiting for copper to move, but the market has been so stuck in this negative spiral about the housing market in China that they don't dare get into the copper market. So we're still shrugging off bad news on that residential side and on property. Before
so would
we
you
can
say
really
real
move
money
forward.
is underweight? If the specs are in and the specs are long and they have that relief through to December, very quickly here, would you say then that real money, there's still room to grow in terms of positioning? Briefly.
Absolutely, yes. Right now it's paper-led, but the physical market and real money is still going to come, and it's going to come over the next 12 to 18 months in a very big way.
OK, there's your call. We'll blast that out, Nadia. That's a hell of a call. Nadia Martin Wiggen at Svelland Capital. But you know what? That's what makes it a special guest. Coming up, we'll bring you Bloomberg's exclusive interview with the CEOs of Dell, NVIDIA. Context matters on Bloomberg. Good morning from New York. It is Bloomberg Brief. I'm Manus Cranny in New York. Well, Dell and NVIDIA, they're teaming up for a new line of PCs optimized for AI tasks. Bloomberg's Ed Ludlow spoke exclusively to the CEOs on the changes coming into the space at the Dell World Conference. Let's take a listen.
This is a great example of how you have an ecosystem of companies coming together along with all these incredible innovations in GPUs and compute and storage and networking and all the AI models and software companies that are utilizing all this power, and it's causing a new industrial revolution.
You know, we want to bring this generative AI capability to every company in the world. Every country has its native natural resource called its language, its culture, its intelligence. And now people realize that because their country's data is part of their natural resource, not just the copper mines and the gold or the lithium or whatever it is, it's also the data is also part of their natural resource, and they have to make sure that they harness that natural resource and transfer it into artificial intelligence.
This is a tsunami of change, and only the smart ones are going to recognize I have to plant the flag now. Whether the story is complete or not is not the issue. The train has moved out.
What a great line there. The CEOs of Dell, NVIDIA, and ServiceNow speaking to our very own Ed Ludlow. The train has left the station on AI and the race. Matt Bloxham is with me from Bloomberg Intelligence. Matt, I mean, it sort of feels as if this is Dell's sort of iPhone moment, or could be. But if you look at AI and PCs, is this going to be enough to revive stagnant demand for them? Is this some kind of pivotal moment in their rivalry with Apple?
I think it could be, and it's certainly going to be the real focus for consumer technology hardware over the next 12 months. We saw a week or two back that Apple launched a new range of iPads with the upgraded neural processors, and I think this is the kind of PC market kind of catching up on that. So I think, if you're thinking about buying a new smartphone or PC, you want something that's going to give you those kind of forward capabilities. So I think consumers are looking for that kind of future-proof capability in the device, and it gives the salespeople in store something to kind of really hook customers into. So I think PC demand has been stagnant. I think IDC said Q1 was the first time we've seen stronger sales volumes for something like 3 or 4 years. So, the market does need something, and I think given the huge focus we're seeing on AI, this is kind of has the potential to be a really big stimulus for the market and bring exciting new capabilities to people's devices.
So let's talk a little bit about NVIDIA. I mean, much has been made of the options trades that are out there. I know that they may not be of a quantum that can actually really impact, but we're looking at some potentially huge swings, plus or minus 8%. So it is a pivotal announcement for sentiment, isn't it?
Yeah, it is. And I think, again, the market's generally positioned to see another beat and raise from them. So, the market is looking for about $24.5–25 billion of sales this quarter. The company is guided for $24 billion. That was a big beat on expectations running into the quarter. So I think really what people are looking for is what they say about the next quarter, and they're likely to give a sales guide. And I think that the street's looking for something like close to $27 billion of sales for their Q2. So I think that's really the number people are going to be focused on, because so far NVIDIA's customer base has been quite concentrated around the so-called hyperscalers, so people like Google, these big kind of cloud platform providers. What they need to, and we heard a bit about it there from the kind of Dell conversation, is they need to extend AI demand into governments and corporations. And so I think that's the story they need to say, is that there is demand coming through from enterprises and governments, and that's going to sustain this revenue growth through 25, 26 and beyond.
Okay, Matt, counting down to NVIDIA, it is going to be the sort of the set of results that will fill or kill this next pre-summer season. Bloomberg Intelligence on the stories. Let's stick with the earnings. We've got Macy's and Lowe's. They'll hit the tape just before the bell this morning, and the market will get an idea of how the U.S. consumer is doing. Bloomberg's Dasha Afanasieva joins me now. So here we are. We're going to get both of these reports. Now, let's focus in on the luxury side, first of all. That's at the core of what Tony Spring, the CEO's new strategy is. And that's against the backdrop. If I look at some of this luxury stocks that we've had report, they've had tough times, tough comps in China, tough times putting through price rises. So what's that going to mean for today's reporting?
Hi. So yeah, Tony Spring is switching to the more luxury part of his business. So that's Bloomingdale's and Bluemercury, which is a rival to Sephora. And I think it's the key thing to realize it's a super competitive space, particularly with Sephora, particularly with people buying their designer goods online. And there has been a downtick, particularly, as you said, led by China. and luxury brands are having a really tough time, like Burberry, Gucci, etc. But I think that his decision is kind of based on how much tougher it is in the more value segment space, which is where Macy's operates. That's why he said that he's going to shut a further 150 Macy's stores, 50 of those this year, and really why analysts expect sales to fall 2.8% in the quarter. And of course, this is all against the backdrop of trying to convince the market that Macy's is better off as a retailer rather than being taken private and possibly broken up into real estate and the retail bit, as proposed by Ark House and Brigade Capital Management. And what's also interesting is that the stock is trading well below their upgraded $24 bid. So it does appear as if the market thinks it will stay listed.
Yeah, I mean, they've upped their bid, haven't they? By 14% after being rebuffed. So it's going to be interesting to see, do they come back again? And what the rationale is there, or what Mr. Spring delivers in terms of a strategy. Hope Depot, they reported last week. Can I read across into Lowe's, because we've got them reporting before the bell? Or what crossover is there in the read?
Absolutely. I mean, Home Depot has been having a tough time with high interest rates. People are beginning to pay back their student loans again. There's kind of reduction in stimulus. So the consumer, the US consumer, is really stretched, and they're not doing that much moving house and redecorating. And in some ways, you can argue that Lowe's is actually more exposed, because 3/4 of its business comes from DIYers, rather than at Home Depot. It's more of a sort of 50-50 split. And, you know, the Fed's recently signaled that interest rates will stay high for a while longer, because inflation's proving particularly stubborn. So that these house renovation companies are unlikely to get relief very soon. But at the same time, over the last year, the stock is up 13% for Lowe's, so it's not all bad.
OK, Dasha, thank you so much. Dasha Avanasieva on the retail outlet. Coming up, more Fed speak, another space launch attempt for Boeing. Context matters on Bloomberg. Good morning from New York. It is Bloomberg Brief. I'm Manus Cranny in New York. Let's take a look at what's ahead for you today. You got it. More Fed speak. Barkin, Waller, Williams, and Bostic all on deck, along with Mr. Barr. Then it's earnings. Macy's and Lowe's, as we've been saying. We get an insight to the US consumer. And after the close, results from Toll Brothers on the building side. Some stocks that are on the move. I mentioned to you Palo Alto. They're extending their decline. They had a disappointing fourth quarter billings, and the firm posted worst single-day drop ever in the last quarterly report. Zoom extending post-earnings decline followed mixed results, weaker than expected earnings for the current quarter, while beating expectations for the last quarter. And of course, Nvidia, you've just got to keep an eye on that stock. We're preparing for some big swings. Yesterday, we had a price upgrade from Barclays to $1,100 from $850, and that helped move it a little bit higher. I want to leave you with a snapshot of the bond market, because there's a significant shift by BlackRock, specifically on the UK. Gilts trade at 414 at the moment. BlackRock is overweight developed market government bonds on a strategic level for the first time in 5 years. This is important, and where they lean into is, of course, the UK. Rates will fall more quickly there. Quick snapshot of that. That's where this dynamic makes the UK government bond yields more attractive than other bond markets in the world. Good morning from New York. The surveillance team, they'll take you through the next 3 hours. Context matters on Bloomberg.